I think you do need decades to do that because of the large upfront fixed cost at the beginning of construction and then the longer period of time which you pull in revenues to pay for that. I do think that longer time horizon requires that longer term, more stable capital. And I think we're seeing more of that in terms of institutional investors in Canada.
Welcome to Colliers Talks, a podcast series featuring the latest trends, insights, research, and developments in commercial real estate in Canada and beyond.
Welcome to our podcast, Colliers Talks Economics. I'm your host, Adam Jacobs, the National Head of Research for Colliers Canada, and we are joined by first-time guest Randall Bartlett, Deputy Chief Economist of Desjardins. Based in Toronto, Randall leads a team that covers the Canadian and provincial economies and housing markets outside of Quebec, and government budgets and fiscal policy. Certainly a hot topic these days that I'm sure we'll discuss. Before joining Desjardins, he was the Director of Economic Research at OMER's Total Portfolio Management Team, responsible for global economic research and forecasting that directly supported investment decisions across asset classes. Today, we're going to explore interest rates, fundamentals, immigration and the labor market, and regional economic dynamics shaping the Canadian real estate landscape, what investors, developers, and lenders should be watching in the months ahead, and how leaders and companies can make better informed decisions in an environment defined by higher costs of capital, shifting demand patterns, and evolving housing and infrastructure priorities. Randall, we're very happy to have you. We have so much to discuss, but this being a real estate podcast, we'll get to the fundamentals, the job market, immigration, but I think the housing market is very much top of people's minds. I just went to the Toronto real estate forums. Obviously, there was a lot of talk about the condo market, about purpose-built rental, about the state of housing affordability. The housing market is on the downswing, I think we have to say, and the condo market is very much on the downswing. So, what is the solution here? Like, what's the way out? Because we're just struggling with, we've been hearing the same thing for years: high costs, high land costs, labor costs, material costs, approval times, soft costs. I think the diagnosis of what's wrong is pretty clear, but what is the way out here that you see?
Yeah, well, I think to your diagnosis has been really interesting, right? We've seen that, the federal government under the previous administration had taken a lot of measures to boost purpose-built rental. We've seen that really leading housing starts this year. And we keep, by we, I mean the economics community, keeps missing on housing starts because they keep coming in hotter than we anticipate. And a big part of that's been purpose-built rentals. So a lot of changes on the policy side supported that. But at the same time, we've seen the condo, the condo sector really slip in the last year or two, and hit really what a the lowest level of pre-sales in 30 years. We've seen a ton of weakness in that market, and so we've seen those really flip, where it's been purpose-built rental that's been leading the charge in new construction and development, the condo sector really struggling. And I think when you look at the condo sector, very much investor driven for 5 years plus now. They went from, I think, an idea where it was going to be a starter home initially when condos really started to come online as a force and really have become an investor-driven market through pre-sales. Now we're in a situation where, because of a confluence of forces, higher interest rates than in 2020 and 2021, in fact, higher interest rates than even pre-COVID, has led to higher borrowing costs, particularly at renewal. And for folks that had variable rate mortgages, that's meant that cash flow has been negative in some cases, in fact, a lot of cases. And ultimately, we've seen that as population growth has slowed too. As we've tightened up immigration standards, or particularly for non-permanent residents, we've seen much slower population growth. In fact, year over year, the population of 20 to 29-year-olds is negative territory. And so it's really created this confluence of forces where you have demand that's declining at a time, or at least slowing at a time when you have supply coming on the market in the form of purpose-built rentals in full force. And so I think there's been a lot of forces that have really put downward pressure on condos in a way that nobody would have anticipated a few years ago.
Yeah, condos were invincible not that long ago. It was 3 years ago, probably. It was the hottest investment. Purpose-built rental is an interesting one, and it's a special kind of category because of CMHC, because of the financing that's available. It's a solution to a lot of developers' problems, which is, if I have a project and condos aren't going to pre-sell, well, it's too late. The project needs to happen. So purpose-built rental perhaps is a way out. But too much purpose-built rental, or just like we see on the one hand, we have a huge housing deficit. We're millions of homes behind or whatever it is. On the other hand, you look at the curve of purpose-built rental and it's going exponential here, and maybe it's a little too much too soon. Like, is this just catching up to something that should have been done a while ago? Or is it possible where sometimes I wonder if we're overextending ourselves on purpose-built rental, as we did with condos, which is it just goes a little too far. There's a little too much money flowing in. And then 5 years down the road, there's some projects that just aren't going to make sense. Where do you see that?
Yeah, I think it's both and, to be honest, where there was this gap to fill. If you look at purpose-built rental as a share of housing in Quebec versus the rest of the country, there's a huge gulf between those things. We saw that there hadn't been a lot of development or building in the purpose-built rental sector in decades, and so I think the average age, I've got the number exactly offhand, but the average age of purpose-built rental stock was 40 years or something like that. So there had been a lot of underdevelopment in that sector, and so that catch-up was necessary. But I think what we're seeing, to your point, is that we're seeing a move out of condo into purpose-built rental because the lending conditions have become more favorable. You've seen institutional investors get into purpose-built rental in a way that they hadn't in the past. You're moving from small individual investors to larger institutional investors. And so it's really changed the dynamic quite a bit of those markets. And so do we risk overbuilding? Do we risk building too much too quickly at a time when we're seeing demand slow considerably? That's quite possible. Then we end up in a situation where we get a dearth coming on the market, and then we end up in a situation where the condo market is right now. And so that's entirely possible. But that's 5 years down the road. We'll see how that plays out. But I think as part of the broader spectrum, we did need more purpose-built rental coming on the market. That does provide some relief to the rental market, which I think then does feed down into greater affordability in market housing as well.
Well, yeah, the affordability part of me thinks that the solution to this is just the same old simple solution. Prices will go down for condos to the point where people are interested, where the so-called end user is now sees it as viable, sees it as a better alternative than renting, because it's sort of a difficult argument right now, given the still high cost of condos. So perhaps it's just a matter of supply and demand evening itself out. Again, you mentioned the presence of the institutions. Yeah, I don't think 10 years ago, like, apartment was seen as more of a mom and pop investor category. It wasn't necessarily the institutional investor or the pension plan or the sovereign wealth fund that was playing in the purpose-built rental space, but that's really changed. That's good because those people have a long enough time horizon. I think what we underestimate about purpose-built rental, people like condos because it was a 5-year kind of investment. You pre-purchase and you assign, or you own it for a few years and sell it. It was very liquid. It was very easy to get out of. That's not necessarily the way purpose-built rental works, though, right? If we're talking about the investor side, you need a time horizon that's decades to make that a viable investment. Is that fair to say?
Yeah, I would say so. Yeah, I think you do need decades to do that because of the large upfront fixed cost at the beginning of construction, and then the longer period of time with which you pull in revenues to pay for that. So I think I do think that longer time horizon requires that longer term, more stable capital, and I think we're seeing more of that in terms of institutional investors in Canada, both Canadian institutional investors like pension funds, but also international capital as well, showing more interest in the sector in Canada.
Now, we're going to get into demographics because there's another way this problem solves itself, which is all the people leave the expensive markets and go move to the affordable markets, and things balance themselves out in terms of pricing and demand that way. And I think we have seen some of that in Toronto specifically, like the outflow of people based off affordability, not based off of an oil boom in Fort McMurray or something, but just based on the cost of living gap is so large between here and Dartmouth, Nova Scotia, Calgary, Alberta, pick your location, that people have just made that decision and balanced it out. So do you, like, I guess I view that as it's both a solution, but it's maybe a bad thing for the future of the city to just be driving people out of the core and having it be so affordable. Like, we talk about productivity challenges. It probably doesn't help to drive out all the young, educated people who can't afford to live here. So do you, again, the initial question, like, is there a way out? Like, do you see a way where people start flowing back to the city because of a better availability of purpose-built rental, because of better infrastructure, because of better economic opportunities. Because I think the housing thing, it turned from like a positive where people were profiting a lot from it to sort of a negative of like, this is almost an obstacle to the young, skilled, educated population being here.
Yeah, and you're absolutely seeing that. When you look at the outflows from the city, like where are younger folks going? They're going to places like Hamilton, they're going to Oshawa, they're going to Barrie, they're going to surrounding communities that provide, all of the benefits that a community provides, but are affordable. And that's the number one thing that's driving them out. There's been, analysis done by StatCan and others on the demographics that are leaving Toronto. The number one demographic group leaving Toronto is kids under the age of 1. Is when children are born, families leave, and young families leave. And that's a big problem because it totally changes the demographic composition of the city, but you're losing some of the people who are your most dynamic, most innovative thinkers that are leaving the city to go elsewhere because they don't have a choice. And which provinces are benefiting? To your point, Alberta is the number one beneficiary, not just of people leaving Ontario and moving to another province, but BC as well. And so we're seeing, because of affordability, a lot of young people leaving the communities they want to live in and the provinces they want to live in as well. And they're really focused on affordability. That's a huge part of what's driving that. Obviously, opportunity is a big part of that as well. And for any big city like Toronto, I think it's the 4th biggest metro in North America. This is an innovation hub. This is a place where we want to keep our best and brightest and attract the best and brightest from elsewhere in the world to come. And affordability is a big part of that equation. So I think purpose-built rental is part of the equation, but also just improving density overall in the city of Toronto. So that's in our neighborhoods outside of where we see the big condo blocks downtown, having more density. So that's even, not just 6 plexes for purpose-built rental, but, smaller condo buildings as well. That's allowing for more duplexes, townhouses, just more infill broadly in the city of Toronto. When you look at the density here, compared to cities around the world, Toronto's way behind. The rest of the world is way behind Vancouver. It's way behind Montreal. And so Toronto has a lot to learn, I think, and a lot to grow in terms of improving its density and keeping its young professionals in the city.
Yeah, now we're getting into the dangerous topics, but there is a role of government policy here. Like you're mentioning, like at the local level, there's rezoning and densification. There's infrastructure issues. And we see some kind of small attempts at things like we'll remove the HST on new builds for first-time home buyers. I'm a little skeptical that that's going to have some, I suppose it couldn't hurt, but I don't think that's going to have some transformative effect on the market. But should they be doing more? Should they be removing the HST on every new home purchase? Or, should they be reinstituting rent control or subsidizing down payments or, providing, like there was the first home savings account, like additional ways to have tax-free ways to get a down payment? Like, is there any kind of like policy lever that you see as pretty obvious that could be pulled here, provincial level, federal level, whatever?
Yeah, I think when it comes to the demand side, reducing the cost that individuals are going to pay, that's a big part of it. I think, we saw that getting rid of the HST on purpose-built rentals, that was something that broadly supported rapid investment in that sector, along with more favorable lending terms from CMHC, that kind of thing. So I think that will induce more demand into that new housing market, and ultimately should help to bring down the cost of new housing. And whether or not that all gets passed on to the home buyer or some of it is benefits the developer as well, that's something that we have to see play out. And I think that's when one of the risks that have been raised, and one of the things that I think has kind of held back the federal government from going all in on this policy. I think it's sort of proof of concept to some extent at this time, but whether it's former Liberal advisors or the Conservative Party of Canada, they're advocating for this policy. And so it seems like that's sort of the direction we're moving in. But I think this really is sort of proof of concept. Do we see that this starts to bring down prices for new housing? And by extension, if you're building new housing and bringing people into that market while your population's not growing, ultimately this should help to bring down the cost of, to some extent, of existing homes as well. Much to the chagrin of existing homeowners, right? So it's going to be a balancing act for politicians.
Yeah, that's where the rubber meets the road, which it is. And I think there's a lot of focus on the municipal level, at least in our world, which is the development charges situation, the soft cost situation, the entitlement time, the approval time, like that has really become a bit of a crisis. Like it's something we've talked about for years, but you see CMHC reporting on it even just this week of like, here's the level development charges have reached. And it's a level that almost precludes housing from being affordable. Like when the soft costs are in the hundreds of thousands of dollars and people say, why aren't we building condos for $200K? It's like, well, it's hundreds of thousands of dollars just on the development charge and approval side. So, I know there's been some things said at the federal level about perhaps a higher level of government needs to find a way to push that down, find a way to subsidize or even trade off. Like if you can bring these charges down, then we can pay for something else. You say you're using the development charges to pay for water infrastructure or something like that. We will give you maybe some money to offset that if you can find a way. Sure. Like, do you see a realistic situation there? Because I think a lot of the frustration is like people on the real estate side are doing their best with the material side, with tariffs, with labor, but the soft cost side just is starting to seem a little bit hopeless in terms of how much it's driving up costs and just there's an inability to make any progress on that side.
No, absolutely. I mean, I sort of feel for municipal politicians in the sense that I think they are constrained in what they can do in terms of raising revenues. And ultimately, current taxpayers don't want to pay necessarily more in tax to fund infrastructure for new homeowners either, right? So it's a trade-off that the municipal politicians are trying to make as well. So I think in that sense, you do need a higher level of government to come in. I like in concept the idea of something like the Housing Accelerator Fund, where it's kind of the opposite of a medieval window tax, where it's basically a door subsidy, right? So you build more housing, you bring down the barriers to housing, you show evidence that the private sector is building more housing as a result of these measures being reduced. You get funds as a result of that. And we've seen in areas, and I think it was CMHC came out with some research on this that showed that in those parts of the country where you've actually seen zoning requirements come down, you've seen development charges come down, and did borrow through the Housing Accelerator Fund, you have seen more housing come into place. So you have seen this sort of virtuous cycle. But in other cities, we've seen a sort of backstep or backpedaling in terms of their ability to actually make things happen. So they sign on to the money and then they don't meet the requirements that they said they would to qualify for those funds. And so I think it requires higher levels of government putting funds in the window, but then holding municipalities' feet to the fire and saying, okay, you said you would be able to meet these objectives for this funding. You're not getting this funding unless you meet these objectives.
I agree. And I generally am not in favor of just holding a hammer over people's head and say, do this or else. But this seems to be an area where that is actually a fact. I give BC some credit for taking a bit more of that approach, which is like, we are sort of setting you a target. And if you meet the target of approvals and new houses, you're fine. And if you don't, then I guess the road repair budget is going to be a little light this year. And that does seem to stimulate some activity at the local government level. I see that we could clearly do housing market all day. It's a very rich topic. Please go ahead. And then I'm going to move on to a couple other topics after this.
Yeah. So, I mean, overall, our view on the broader housing market in Canada is that we're expecting to see starts slow a little bit into next year, just given the conditions that we're seeing now. But ultimately, we expect starts to continue tracking higher going forward. We're seeing a lot of funding put in the window. Build Canada Homes wasn't as ambitious in the budget as was anticipated in the election platform. But at the same time, we do see a lot of movement in the right direction. We're seeing provinces, particularly big provinces like Ontario, like BC, start to move in that direction of providing a sort of a policy framework that's more coordinated across levels of government and pushing more toward building more homes. So we're fairly optimistic on that front of things. We do see some improvement in affordability in Ontario's in Canada's least affordable provinces, but nothing getting us back even close to where we were pre-COVID. So we do expect that challenge to continue going forward. A big part of that is just costs of building. So you've touched on this, whether it's material costs, whether it's labor costs. Costs are just generally high for building. Whether it's not just the borrowing costs and the development charges, costs are just high. We look at the residential construction cost index. It's gone up at twice the pace since the end of 2019 as the CPI. And as economists, we like to talk about the CPI, but when you put it in the context of what's happening with building costs, it's not even close. It's been, and that's a challenge that I think all levels of government need to look at and figure out how we're going to address this in an environment where you've got a trade dispute with our biggest trading partner. So I think removing the retaliatory tariffs was a step in the right direction, but there's a lot more that needs to be done to start bringing down costs of construction overall.
Amen to that. Let me move on to a favorite topic of mine, which is demographics, which is, kind of what's driving all of this. Sort of real estate, housing market. We've, like all things COVID, we went through sort of a crazy yo-yo situation. We were at a normal level of immigration. We closed the borders. It went down to zero. We reopened and immigration went up to a level that I'm not sure anybody anticipated. We were at quadruple the normal levels, highest growth rate in the world level immigration. And now that seems to have very, very, very sharply pulled back down to, zero, negative, like a level that's significantly lower. So for a long time, demographics and immigration was a huge tailwind for real estate. No question. For the demand for everything, for spending in enclosed malls, for rental apartments, for the condo market, for e-commerce and fulfillment, everything. But now we're all kind of contending with, okay, this is a huge pullback. This is temporary. This is permanent. This is the new paradigm. Like, I guess the forecasts we've looked at from like vendors say this is a sort of 2-year getting things back to normal, and then immigration goes back to whatever it was before, but that's still a fairly high level compared to the rest of the world. But like, what is your view on that? I'm sure you guys are looking at the population side and the immigration side on a daily basis.
Yeah, I mean, our perspective on this is that the federal government's put in some pretty aggressive targets in the window. We are seeing that population growth is slowing, and when we look at youth age 20 to 29, we've actually seen that population growth has been negative now year over year for the last couple of months from the labor force surveys. So certainly we are seeing that is coming into effect. The federal government gets its wish. We're going to have negative population growth for a couple of consecutive years. But at the same time, we think it's likely the federal government is going to make adjustments on the margin as they're feeling a lot of pressure from business, in my view, to actually start allowing for more immigrants through the traditional immigrant stream, economic immigrants in particular, those folks that add a lot of value to the Canadian economy, whose, inflation-adjusted wages are higher than, most folks born in Canada. Like it's, they add a lot to the economy. They pay a lot in taxes, and ultimately support a lot of the programs Canadians enjoy, public services. Also, on the temporary foreign worker front, we've seen this year that some of the industries struggling most are those most at the forefront of this sharp decline in temporary foreign workers. So that's agriculture, that's accommodation and food services. So we are seeing that is having a drag on the labor market and an overall drag on the Canadian economy. That said, I think after a couple of years, regardless of whether or not the federal government is as aggressive in the near term as it says it's going to be, we'll probably get back to something that looks a lot more like what we had from 2015 to 2019, say, where we still have, healthy levels of immigration, but at the same time, it's going to be more focused on permanent residents, more focused on economic immigrants that add a lot of value, and less focused on temporary foreign workers. It'll be very industry specific. And then on the international student side of things, something that, is more likely to, again, add value to the Canadian economy and lead to a path of permanent residency for highly skilled, highly educated individuals, as opposed to the sort of the rush for the border that we saw in 2022, 2023, as job vacancies topped 1 million in Canada. And I think the federal government just, talked to business and recognized that there was a need to satisfy some of these job openings. Otherwise, we were going to end up in a situation where we'd have potentially wage-driven inflation, in a situation where it was, we could find ourselves at the opposite end of this, where inflation would have different drivers, but one where the labor market would be highly challenged.
Yeah, and I think we saw the downside of that as well. And I don't really blame the government for the pullback that's happened. I think what we're seeing in the forecast we look at is initially that pullback was, oh, well, it's just for 12 months. But that time frame seems to be getting a little longer. Like the pullback to almost like near zero population growth is now maybe like a 3-year thing. Like I was a little surprised the last time we looked at this, and now the forecast is like we're maybe 2028. It's sort of back to a normal level of growth. Again, this is a big lever in the real estate world, and something that, one of the reasons that housing got so hot was just that you started to look at these immigration levels and incorporate it into underwriting and start to, we're projecting forward that the population will be 50 and 60 million in the near future. Once we pull that away, some of these projects don't look as viable. So like, it does seem like, I agree with you that there's a tension of there will be pressure to kind of increase immigration from various areas, but you see this as taking a couple years to develop back to like the sort of pre-lockdown situation.
Yeah, absolutely. I mean, our outlook is essentially the same, that we're expecting to see that, we'll have flat to, maybe slightly positive population growth over the next couple of years, but it won't be until 2028 before we start getting back to something more typical for the Canadian economy. And certainly that's going to be something that's going to be a struggle, I think, in the real estate. And you're already seeing it now, where there's the condo side of it, a lot of investor-driven rental. And so that's obviously being impacted by negative cash flows in a lot of cases. And then you've got the purpose-built rental side of things, where probably a lot of those investment decisions were made when immigration was high, when population growth was quite strong. And now we're in a situation where some of that is going to be challenged as well, where some of those cash flows are going to be in a difficult spot. We're seeing asking rents in most major urban areas, negative year over year, and it have been for a little while now. So it's really a bit of a challenging environment for real estate, I think, in the context of having this very weak outlook for population growth going forward. But one thing I think is interesting about it is that I think part of why the government is continuing in this direction is the fact that, there has been, I think, the political consensus in Canada around immigration has become challenged. And I think that's a big part of it. Canadians generally, historically, very supportive of immigration. I think much less so now, in part because there were so many newcomers coming into the country so quickly. And we saw the cost of living going up by so much, not just because of that, but just generally at the same time coming out of the pandemic. And so all of this, I think, combined for a bit of a perfect storm. But when I think of government policy, I always like to use Hanlon's razor as kind of my first lens on that, which is, don't attribute to malice that which can be explained by incompetence. And I think, I think in this case, to your point, I don't think anybody anticipated these numbers coming into the country as much as possible when they relax the conditions by which people could come in. And, I think that generally with government policy, when it goes off the rail, it's because of things that, policymakers just didn't anticipate as being outcomes that had, in some cases, negative externalities.
Yeah, one more demographic question. I want to shift gears a little, but movement within the country, obviously it's not as significant. Like immigration is always more significant than all of these other factors. But we were talking earlier about a lot of more mobility than normal within the country, people relocating, maybe not. If the old paradigm was you leave Ontario to work in the oil sands in Alberta, or maybe you leave the Maritimes to come to Ontario for work or education, that all went backwards. It all went the other way, which is you leave Ontario to go to Nova Scotia because of the lifestyle and the affordability and the lower cost of living. I guess we're starting to see that trend subside a little. For a while, it was really driving the real estate market, that there was a ton of the secondary, tertiary markets were very, very hot. There was a ton of growth there. And these were areas that never had growth, that hadn't had growth for decades. They probably had negative growth. So it was a huge tailwind in those areas. But I think we're starting to see that level off. Like when we look at the outflows of Ontario to the rest of the country, they're just not at the level they were at 2 or 3 years ago. Do you see that as a one-time kind of trend, just driven by remote work, lockdown, whatever?
Yeah, we do see that as a one-time sort of trend in the extremes that it was in. Certainly, people were leaving Ontario and BC to go to Alberta, leaving Ontario to go to Nova Scotia, even leaving Quebec to go to New Brunswick. But we saw that a lot of that has started to slow considerably. To your point, and I think part of that story is an improvement in affordability in places like Ontario, where we have seen that prices have come down since pandemic peaks and they've stayed relatively low. We've seen remote work start to go into reverse as well, and more of a hybrid model, and now more people back in the office. And so the ability to work in these more affordable places, I think, has become more difficult for a lot of younger families, for instance, and young professionals. So I think you've seen a lot of that movement back. Where we could still see some movement out of Ontario is among older demographics. So those are folks who are retiring to places like Nova Scotia, where it is more, where the weather's a little bit warmer, maybe, and the lifestyle a little more laid back, but and affordable. But that's not necessarily to the benefit of places like Nova Scotia, where those folks are on, not necessarily paying high income taxes, but then also obviously have high costs for services.
That's interesting. Okay. Speaking of remote work and its possible end, here we are. I would say the story of this year, other than Trump and tariffs and the trade war, is the sort of surprising return to office momentum. And I personally earlier this year sort of thought perhaps it's just too late for return to office. It's already been 5 years. There hasn't been a clear catalyst to need this, but we're seeing it happen everywhere: government, finance, major industries. Elaborate on the connection between the labor market and return to office, because I think the cynical view is the labor market has weakened a lot in the last couple of years, and this is just shifting the balance of power back more towards the employer, which is normally where it is, and that's where return to office is coming from. But what are you seeing in the labor market, and do you see that as connected to the return to office story we're seeing in 2025?
And so the developments in the labor market have been really interesting, because I don't think they're what a lot of people would have expected over the last couple of years. So certainly when we had this rush of immigration, it was mostly people between the ages of, say, 18 and 34 who were coming into the country. And so what we saw is among youth, that's where we saw the unemployment rate rise most quickly, where we've seen that in those areas that had the sharpest increase in youth population are the ones that saw the highest increase in the youth unemployment rate. So pretty intuitive there. And so when we look at the state of the economy currently and where unemployment rates are relative to their traditional relationships with the economy, it's really very much youth where we've seen that rise in the unemployment rate very quickly. And so among older demographics, we actually would have expected the unemployment rate to be higher than it is right now, given the state of the economy with the trade war and all the uncertainty that's created. And so very much concentrated among youth. But as we see that, because of that, as we see that the youth labor force starts to slow in terms of growth going forward, that's going to continue to be a sort of a tailwind to the unemployment rate by keeping the unemployment rate lower than it would be otherwise, given the state of the economy. And so I'm not sure that the labor market is actually in as bad a situation as I think the last couple of years would have suggested. And actually, it's tighter than you would expect, given how weak the economy is right now. And that actually is keeping wage growth relatively elevated in Canada. It's been outpacing inflation for a while now. And we look at where we were in 2019, real wages are materially higher than they were at the end of 2019, despite this high inflation. And that's because of strong wage growth. And I think that we could continue to see labor actually have a fair bit of bargaining power going forward as as the federal government keeps a lid on newcomers coming into the country.
That's interesting. Yeah, you elaborate on the labor market immigration connection. And I think, I hate to be saying it could be worse, but when January 2025, I think the expectations were, certainly people were saying, double-digit unemployment is possible. Like the point we've arrived at now, I agree. I'm somewhat surprised. It's certainly higher than it was in the era you were discussing 3 years ago. There's 1 million vacant jobs. We can't find anyone to work. This is a new kind of crisis. We're sort of back to a more normal to weakish labor market, right? Like that's not an exaggeration, where the unemployment rate's higher than it was 6 or 7 years ago. But I think compared to maybe expectations, especially with the downside of the trade war, things are holding up a little better. And I think our observation is this is the labor market is highly uneven. Like the labor market is pretty bad if you're in automotive or metals or agriculture or some of these areas where tariffs are the number one story. If you're in insurance and finance and real estate and government, I'm not sure that the labor market is necessarily that weak at all, right? I think it's fairly tight in those areas. Is that too simplistic or?
No, I think that's absolutely right. I think because the way that we were thinking about it as economists back in January 2025 are these broad-based tariffs on everything going from Canada into the US, expecting, I think it was ubiquitous that everybody's expecting recession and high unemployment, even double-digit unemployment in some provinces like Ontario. But ultimately, what we've seen is that hasn't played out. That Canada has one of the lowest, effective tariff rates on its exports going into the U.S., highly sector-specific. And in those sectors, you are seeing displacement, whether it's, manufacturing, wholesale trade, metals production. You are seeing it in those areas. But when you look at those parts of the economy that aren't as impacted, they're actually largely running as you would normally expect, given a relatively weakish economy, but not one that's anywhere close to a recession.
Yeah. Now let's get to the job market meets return to office meets real estate. Here we are recording this in lovely downtown Toronto. Return to office is in full swing. I think it's certainly more noticeable compared to 6 months ago, 2 years ago, whatever. But it is downtown has some challenges. We see this on the real estate side, which is historically downtown office, lower vacancies, higher rents, more development. That's where people want to be. The trend pre-COVID was, I'm going to leave my suburban office park and I'll move downtown, even though I have less space, even though it's more expensive, but I have better access to employees. The clients are there. It's just worth the trade-off. People have shorter commutes, whatever. That's not the case anymore. Downtown vacancies are higher than suburban, and that's not just Toronto. Toronto, certainly that's the case. It's the same in Vancouver, and it's the same in Winnipeg, and it's the same in every market across the country. And we hear all the time, which is, downtown is more difficult than it used to be. It's more expensive. It's harder to find parking. There's more construction. There's more traffic. The infrastructure isn't as good. Transit is more difficult, whether that's the subway, the streetcar is delayed, the GO train is more expensive, whatever. So there are some obstacles to downtown. Now, I'm a big believer in downtown, but I think it's frustrating for the office landlord or even the office tenant, because these are just huge structural things. What am I supposed to do about the fact that we're building the Ontario line for the next 14 years? Like, the building is where it is. My office is where it is. Like, how do you see, what's the prognosis for the sort of challenges we're seeing downtown in terms of just getting people back, getting back to a more vibrant downtown?
Yeah, I mean, I'm a big believer that in this idea that cities are probably one of man's greatest inventions, if not the greatest invention, where you create these enormous network effects. And I think it's incredibly important that people are able to get downtown, be able to move around, and be able to actually engage with one another in a city. And I think these challenges are partly multifaceted, where some of it is a demographic question, where we had very, very rapidly increasing population in Canada. A lot of those folks were coming to Canada's biggest cities because of, this is where the diasporas are, right? This is where all of those cultural links are in Canada. And so I think a big part of that was just we've seen population rise so quickly in those big urban centers. And so you just have more people using very limited resources in the same space that we had before. And so a lot of this infrastructure, I think, now is coming in to help accommodate a lot of that growth that we're seeing in terms of population today and in the future. A lot of this probably should have happened in previous decades. It didn't happen, and so a lot of it is that's part of it. I mean, infrastructure is not something in Canada that we have much of a track record of doing well and building in a way that's timely and efficient, and we're actually able to bring this online quickly. And so it's a challenge, particularly when you're trying to catch up with a past underinvestment. And so it's something that I don't know if we're going to see change materially anytime soon. But what I do think culturally has changed a lot at least what I'm seeing when I'm talking to clients, is the amount of flexibility generally around back to office. That, 2019, you were expected to be in the office, suit and tie most of the time, if not all the time, 5 days a week. That was just a general expectation and had been for decades. Now it's a more flexible environment where I think there is that opportunity to be able to work with employees in a way that's different, and that's really going to maximize those network effects, where you can increase that productivity and really maximize the output of employees in a way that will allow them to still maybe avoid some of the most challenging parts of coming in and out of the city on a regular basis.
I agree. And I think it's important to remember, we talk a lot about RTO mandates. Like, there actually aren't that many 5-day-a-week RTO mandates. Like, many of them are still 3 or 4. And we'll have to see about some of those 5s, as we were discussing before the show. I think there's perhaps some conflict coming on those sides. It's well and good for the government to say 5 days in office, but it's a unionized environment, and there's a possibility for pushback and negotiation there. Okay. I want to get to everyone's favorite topic in real estate, which is borrowing costs and rate cuts. I think, in my view, it's shocking how stable borrowing costs have been in the last couple of years. They really aren't that different than they were a year ago or 2 years ago, which, given everything that's happened in the world, you would think they would have fluctuated quite a bit more. But if we're just looking at the headline kind of 10-year Canada bond rate, it hasn't really changed that much. It's been in the 3 to 3.5% range for years, despite rate hikes, despite rate cuts, despite Trump, despite everything. So I think earlier this year, the outlook was, well, okay, the worst is over, and there's certainly plenty more rate cuts to come, and maybe we'll get back to the really supercharged rate environment. That ship seems to have sailed. So let's just start with, like, what's your outlook on rate cuts? Like, we're done for 6 months, for 5 years. Like, how do you see this?
Yeah, well, we think the Bank of Canada is done for now. I mean, the meeting tomorrow, we don't expect any change, and we're not expecting any change through to at least the end of 2026. And that's a bit of a change in our outlook too. We expected another cut to come either in December or January, but what the Bank of Canada said in its October monetary policy report, and the press release put out by the governor, was that the bank thinks that from a cyclical perspective, it's pretty much done what it can do at this point, because this trade shock that we're experiencing from the U.S. is leading to structurally lower growth in Canada overall, less investment, lower growth in the country. And then you've got the population headwind as well, which is also going to lower growth over the longer term. And so the bank's view is that those aren't things that can be solved by monetary policy. Monetary policy can't make trade deals. Monetary policy can help induce investment by lowering rates, but it can't provide longer-term incentives. It can't change the regulatory environment. It can't do that sort of thing to provide that certainty for long-term investors. And certainly, it can't affect immigration policy. And so the bank has basically handed this off to the federal government and said, all right, now it's your turn to do something, and then we'll see what's in the budget, because that last meeting was a week before the budget came out, and then we'll adjust our decisions based on that. But in our view, the bank has basically said, we've done what we can do on this. We want to make sure that inflation, which is kind of in the 2 to 3% range by and large, doesn't get away from us again. And so we think this is the right rate policy for the right time.
Yeah, I share that view. I think it's just a little disappointing, given where we were maybe 10 months ago. People thought there was a much clearer path. But there is a clearer path in some other economies to further easing, right? Like, we were waiting for the U.S. to kind of ease off on what were some pretty high rates, and we're starting to see that. But we're well below, like, the divergence between Canada and U.S. on rates is at like record high levels. That doesn't usually sustain long term. Either ours go up or theirs go down. It seems likely that theirs go down, right? Like, what's the U.S. outlook is just, it weighs so heavily on all the discussions and the lending market and everything. So what's your view on that?
No, absolutely. And we think the Fed's going to cut tomorrow, and we think it has a couple of more cuts baked in as well before it's done on this cycle. Certainly by sort of the middle part of next year, we think there'll be 3 cuts altogether by the Fed. Now, there's a lot of dynamics at play there in the U.S. We're seeing that the unemployment rate remains relatively contained, but there's some obviously immigration things happening on their side as well, where you have, relatively low payroll increases overall, but you're seeing that the labor market isn't really growing at the same pace that it had been before either because of immigration. So it's one of these things where the U.S. is going through some unusual dynamics. The Fed's got to kind of wade through in the labor market to understand what's happening. And then on the inflation side, inflation remains relatively elevated in the U.S., above where the Fed really seems to be comfortable with it. But it does seem to be comfortable enough weighing off those two pieces of the labor market and inflation to continue easing going forward. And so we think that the Fed is going to be continuing to head in that direction. Obviously, there's a lot of politics happening in the U.S. around the Fed that we don't have in Canada. Kevin Hassett seems to be the front runner to be the next chair of the Federal Reserve Board. And so we'll see how all of those dynamics play out. But he's only one voice on that, one voting voice on that relative to all of the others. And so we're not expecting a huge shift in Fed policy independent of the politics that are happening there. Contrast that to Canada, where you've got one voice that matters, and that's the governor of the Bank of Canada. We look further out the curve, though. I mean, U.S. yields had been staying relatively sticky further out the yield curve, and a big part of what was driving that was term premium. And so we'd seen that, even though there was an expectation that we would get Fed rate cuts, so short rates would come down, bondholders required higher interest rates to hold U.S. treasuries. And that's because of the overall pro-inflationary policy that we're seeing in the U.S., whether it's tariffs, large budget deficits. There's an expectation that we're going to see more issuance and higher inflation in the U.S. That's pushed up term premium there, and it's pushed up term premium here and around the world as well. When we break out the domestic and global factors driving term premium in Canada, domestic is dragging. It's actually all global factors, largely imported from the U.S., that's boosted our term premiums and kept our longer-term borrowing rates, whether it's 5, 10, 30 years, higher than they would be otherwise.
We could do a whole podcast on this topic, and we haven't even talked about lending. I'm just talking about the superficial level of the bond yield. The lending environment, from everything we hear, has actually improved in the last year. You're not paying the spread you were when the fear factor was a little bit higher. Anyway, our time is short. There's, we do have to talk about tariffs a little bit. You threw out something earlier about how much construction costs have gone up. As much as inflation has gone up, construction has gone up even more. What is your outlook on this? I guess my view on inflation is the worst seems to be over. I mean, remember where we were 2 or 3 years ago. It was sort of completely out of hand. Everything, food inflation, rent inflation, all the essentials. It's coming back down. On the same time, we were just looking at this the other day, and the essentials are not really coming down. That the things you actually need to live, like insurance and a place to live and food, are still high. And it's nice to say the cost of an iPad has come down 5% or something, but people say I can live without an iPad, but I can't live without food. So what is your outlook on inflation? It's under control, or it's just selective? It depends on the sector.
Yeah, I mean, our view overall is that inflation is going to stay around 2% over the next couple of years. And, core inflation, that's headline. Core inflation going to be a little bit hot still, as it is now, and around, we're in line with the bank's view of underlying inflation around 2.5%. And but that'll continue to track lower as well after some volatility at the end of this year, beginning of next. So ultimately, we are expecting inflation to continue tracking at around 2%. Now, a big part of that is, even when you look at back where we were at the beginning of the year, we were forecasting inflation of, upwards of around 3% at this time. And a big part of that was those retaliatory tariffs that were going to put upward pressure on inflation. And those were on everything. We did some deep dive into this. And so it was on things, the first round really hitting American exporters hard, targeting those export sectors that, where Canada is their largest market. So, people love to talk about bourbon and that sort of thing, but it was those kind of sectors. But then it became really broad-based the more that we put on the U.S., and it was hitting food, and it was hitting all elements of construction inputs. In fact, construction was the sector that we thought was going to be hit hardest by those retaliatory tariffs. And ultimately, that feeds into shelter costs that Canadians pay. And so taking those retaliatory tariffs off helped to bring down the inflation outlook over the next couple of years. Then you've got the scrapping of the consumer carbon tax. Now, regardless of its merits as an environmental policy, certainly that provided immediate relief to Canadian households, both at the pump, in terms of heating their homes and electricity costs more broadly. And so ultimately, this helped to bring down the cost of energy for Canadian households and has really kept inflation at around 2%. Those two measures in particular, which were tax measures, ultimately, whether it's a tariff or whether it's a consumer tax, those were tax measures that, because they're permanent as well, help to permanently reduce the level of inflation relative to where we would have been otherwise.
Yeah, and inflation's another area where I hate to say it could be worse, but the discussion we were having 10 months ago was pretty frightening about inflation. And now here we are. It's okay, it's maybe a little bit higher than we would hope, but it's certainly not at the 99th percentile of what was being discussed. Now, like a final question, like to the housing and commercial development side, like, this is called comfort. Like, construction costs are very high. And I think the feeling was this was perhaps the year where it turned over, where you can't just go up infinitely. Like, at some point it turns around because the labor market softens, or there's better availability of materials from abroad or something. Like, what is the outlook? Because it's such an obstacle. We talk about the need for more housing, and at the same time, we're talking about an environment where development and underwriting is incredibly difficult because of high costs. And then if you're talking about inflation, I guess it's going to be even worse 5 years from now when the costs are even higher. Like, what is the outlook for that getting better? Like, is it just offset by the improvements on the financing side, or is there some way out of that high cost situation?
Yeah, so I think, improvements on the financing side, improvements on the regulatory, hopefully development charge side of things. That's where governments, I think, can play the clearest role and the most immediate role. But then, we're still expecting that residential construction costs and non-res costs too are going to keep climbing into next year and outpace inflation. And the reason for that, again, comes down to material costs and comes down to labor costs. At a time when we're seeing that labor cost, we're reducing the pace that the labor supply is growing in Canada and the labor force is growing. It's, we need to bring more people into the construction sector in order to start, slowing the pace of wage and compensation growth on that side of things. These folks are skilled. They need to be trained, but recognizing credentials across Canada. So I think that's hopefully going to help and be part of that, reducing those interprovincial trade barriers to credential recognition. And so ultimately allowing, electricians and plumbers in one part of the country where we're seeing the labor market is slowing to be able to move to places where the labor market is hotter for better compensation and hopefully even out that across the country a little bit more. So that's part of it. Recognizing international credentials as well. I'm not sure that electricity works any differently in Germany than it works in Canada. And so being able to recognize that more broadly internationally, I think will go a long way to helping in that sector. And when it comes to material costs, part of the issue we get into in Canada is that, we've historically been drawers of water and hewers of wood, where we've pulled the stuff out of the ground, sent it to the US for a lot of the refining and production, and then re-imported the products that we use. Now, a lot of that is changing because supply chains are changing so much in Canada and globally as a result of U.S. trade tensions. So I think there's the pandemic shock and then now the tariff shock that's come in. And so when we look at steel producers like Algoma and Sault Ste. Marie, they're retooling considerably as a result of the fact that they're hit with this tariff shock and 60% of what they produce went to the U.S. Now, much more of that is going to have to be sent elsewhere around the world, but also consumed in Canada. When it comes to forestry products, they're seeing that anti-dumping and countervailing duties continue to rise in the U.S. It's not even a tariff story necessarily. A lot of that was in the works back in 2023 of the latest round. And so it's one of those things where we are still producing a lot of these inputs to construction. We just need to use more of what we produce here, ultimately reorient some of that production toward domestic uses and allow building codes to adjust to allow for things like mass timber and other types of construction techniques that will support using materials made in Canada. But it's not going to be a quick fix. that's still going to be a sort of a medium-term, longer-term play, as opposed to something that we'll see in the next year or two.
Okay, one final question. We don't have time to get into the whole budget. I know you have done a lot of analysis on that, but to this point of inflation, labor supply, I guess I've seen it both ways. This is a visionary budget, like it or not. It's a different approach. It's a higher deficit. It's a greater focus on infrastructure, trade diversification, investment. I've heard it both ways. One is this is going to be a real boon to the real estate industry. We are highly dependent on infrastructure, transportation, all of these systems, which are lagging. But per our discussion, I've heard it the other way. All these skilled laborers are going to go build chromite mines in northern Ontario and high-speed rail tracks out in the country, and that's actually going to be a huge impact on the real estate and development industry, where we're always struggling on the labor side. Mm-hmm. And a big visionary government commitment to infrastructure might actually make this situation a lot worse. Now, let's take the long view and say 20 years from now, it will be worth it or it will be better. But in the short term, is that a viable concern, or is that beyond what we should worry about?
No, I think it is a viable concern. I think that our current policy towards skills training, immigration, and infrastructure development and defense as well are inconsistent with one another, where our defense policy is to build massive new defense infrastructure. We want to generate more investment in infrastructure, ports, pipe, roads, rails. We want to build all of these things. But at the same time, the federal government's policy as it's rolled out is that we're going to see our population decline over the next few years. So the question is, how do you do all of this while being labor constrained? And I think that's what leads to the conclusion that I have, that they're inconsistent with one another, and we need to focus on, okay, what do we need in terms of materials and capital? What do we need in terms of labor? And then figure out how we're going to get that labor here in Canada to build all of these things, and do it in a relatively short order, because we need it. And the federal government's plan is to build. So we need to have the inputs to do that.
Thank you so much, Randall, for joining us. We've gone on for over an hour. We could keep going, but maybe there will be a part 2 at some point. This is Colliers Talks Economics. I'm Adam Jacobs. Thank you to Randall Bartlett of Desjardins for joining us today.
Well, thank you so much for having me.
Thanks for listening to Colliers Talks Podcast. To learn more about Colliers Canada, our experts, and our solutions, visit collierscanada.com or find us on LinkedIn, Twitter, and Facebook.